taking a look at some global market action now. The US market is trading mixed after it opened flat on weaker than expected August jobs report with its impact on US monetary policy. Now, the US economy created lower than expected jobs as non-farm payrolls for August expanded by 142,000. Now, this reflects the slowdown in the US labor market. But the unemployment rate came in line with estimates at 4.2%. And to take us through more and perhaps potentially explain what this could mean going further, joining us is Peter Cardillo. He's the Chief Market Economist of Spartan Capital Securities. Hi, Peter. Thank you for joining in. Good to see you. Weaker than expected August jobs report coming in from the US. Now, hiring seeming a bit tepid for August, but the unemployment rate coming in line at about 4.2%. How do you see this data and its impact?
Yeah. Well, to begin with, the growth of 142,000 jobs was a little bit higher than I was expected. The fact that the unemployment rate dropped to 4.2%, I think, is mostly due to the participation rate that was unchanged. And this data that we got today was weak, and obviously was weaker than market consensus, a little bit higher than I was looking for. But if you take into consideration the revisions, this makes the employment data weak. However, I will admit that this lessens the chance probably for the Fed to cut rates by 50 basis points at the September 17, 18 meeting. So that is a plus, let's say, for the markets, in the sense that there's no urgency for the Fed to cut more than expected, as negating the fears of a real slowdown in the economy. Now, that does not exclude the fact that the labor market is weakening, and it's weakening rather fast. So I think today's report sets us up for at least 3 rate cuts this year, totaling 75 basis points. So there's a good possibility that we see a rate cut in November and of 25 basis points, and one in December of 25 basis points, or they may skip to November and wait for more data and cut 50 basis points in December. Bottom line is that interest rates are going to come down.
Right. So as you're pointing out, of course, this is obviously going to fuel that ongoing debate about the percentage of the rate cut. But apart from that, this is weaker than expected August jobs report. Now, today in India, the markets didn't do very well. They were both NSE and BSE down about 1% on fears of what this could mean going forward.
Yeah, well, the markets are acting accordingly. If you look at what's happening, the stocks are mixed right now. You have yields that actually were lower. The 10-year had dropped under 370, and now it's back up to that 375 level. The metals were higher, and now they're off a bit. And you have the dollar that's gaining. So I think this, basically confirms what I said a few moments ago, that the need for the Fed to become more aggressive in September has lessened. And so that's a relief to the markets. It certainly, puts in play the soft landing forecast. Now, it's too early to say whether or not the Fed is going to be right or wrong when it comes to a soft landing. There's a possibility that we might be headed for a hard landing, but certainly not anytime soon. If that happens, it's going to happen in the latter part of 2025. But for now, the markets are not forecasting a hard landing.
All right, Peter, thank you very much for joining us and taking us through what this could mean.